Sage reports full-year results for 2015 today, and I'm joined now by CEO Stephen Kelly to talk through some of the key aspects. So Stephen, what are the highlights for you?
Well, I think we're pleased that we exceeded the targets established by the prior management back in 2012. And we've outlined at the Capital Markets Day a significant transformation program for the company. And even now we're seeing some green shoots associated with that transformation. So some of the elements of 9% increase in growth on recurring revenue, subscription growth of 29%, and actually the subscription contracts to be 690,000 is impressive. And then around the global products, I think one of the favorite products for startup businesses is Sage 1, and to see that growing at 100% compound growth is impressive, as is double-digit growth on the X3 enterprise product.
You set out a strategy to transform the business at the Capital Markets Day in June. Can you tell us how that's progressing?
Well, in terms of the transition and the transformation, let's be absolutely candid. We established during the course of last fiscal year a root and branch review, looking at the business, looking at the operating model, looking at the organizational design, looking with a lot of external customer and market data and technology trends. And that gave us the foundation for the plans we're putting in place. And around some of the elements around, obviously, I think really critical that we've got a fantastic install base of millions of customers. We want to cherish that and increase the stickiness associated with our existing customers. And again, just to think that we drove a number of strategies, particularly last year, around cross-sell. And we're seeing, as an example, on Sage Pay in the UK, over 100% increase in terms of the revenues associated with that. So that was impressive. I think the other factor that we're seeing around the transformation is really investing for growth. So it's nice to see all the growth coming from our growth categorized products, and 87% of our R&D investment going into the growth product. Now, and the final thing for investors is the baseline case is really established around our existing customers and continuing to drive customer for life strategies. But the incremental opportunity for growth is associated with the global products. And it's nice to see Sage 1 and X3 and Sage Live come into market. And through the customer business centers, we do see that as an incremental opportunity, and the whole focus around improving the quality and the sustainability of growth becomes very important.
You mentioned changing the culture there, and this is clearly an ambitious plan. But in a fast-moving industry, are you moving fast enough?
I think it's a good question. I think what we did do through the review was look at the technology changes. Obviously, I think what we've done clearly, and it's validated by some of the product awards we've received in the last year, is leapfrog the competition. So there's a lot of competition came with first-generation cloud solutions, which pretty much hard-coded. Now what we've done through our cloud platform strategy is leapfrog the competition, and with things like Sage Impact, Sage Live, we clearly see us kind of accelerating ahead of the rest of the marketplace. What I would say in terms of the importance though is we've got a very experienced management team. Steve and I and the rest of the management team have done this before and actually managed transformations on a significant scale. And what's really important message for our investors is we'll be very measured, very disciplined, very precise, and we'll make sure the sequencing of the program delivers the results we want for the long term, which is all about sustainable long-term growth.
Looking ahead to 2016, how would you characterize the outlook?
We'd be confident to say the outlook for this year is organic growth of at least 6% and operating margins of 27%. And I think where we're focused is some first-year investments, so we'll leave the year, at the end of the year, with accelerated momentum.
Stephen Kelly, thank you very much.
Thank you.
I'm joined now by CFO Steve Hare to look in a little more detail at the numbers. So Steve, what for you are the highlights of the results?
Well, I think building on the first half results, the recurring revenue growth of 9%, underpinned by 29% subscription revenue growth, continues that momentum. But that's also accompanied by a 12.6% increase in underlying earnings per share and a 21% free cash flow as a percentage of revenue. And that's also then allowed us to increase the dividend by 8%. At the same time, we've really started to invest for growth to ensure that we have the right momentum going forward. So we're very focused on where our research and development expenditure is going, and 87% of our expenditure is now on growth products. And in turn, those growth products have driven that 9% recurring revenue growth. So overall, I think a good, strong set of results, which creates the right momentum for the future.
You've made some changes to how you classify revenue. Could you talk us through those?
Sure. As Stephen said, we did a root and branch review of the business, and as part of that, we really wanted to simplify and make more transparent the way we report. So one of the things we've done is introduce a new category of revenue for payments processing, which splits out from recurring revenue, the processing revenue, which comes largely from the payments business, and which is more volume driven. And so the recurring revenue that we disclose now is much more focused on software subscription, with the payments revenue shown separately. I should emphasize that none of these changes have any impact on cash. They're simply designed to give people better visibility of the drivers as we move to a more subscription-based recurring revenue model.
The transformation program contains a lot of work on efficiencies. What can you tell us about that?
So the key is to create the capacity to grow. We need to ensure that the business is operating as one Sage globally, so that we have the capacity to grow efficiently. At the moment, for example, we have 139 locations and over 12,000 suppliers. And this is a byproduct of the fact that we operated as a decentralized business. Over time, we need to operate from less places, and we need to simplify how we work with our suppliers, and that means less suppliers. It also means that over time, we need to make cost savings that we can then reinvest for growth, particularly into digital marketing. So we're saying that as we exit FY16, we will have annualized cost savings of around £50 million, which will be, as I say, reinvested into digital marketing. And this will continue over the coming years as we look to make our organisation scale in a more efficient fashion.
Looking ahead to the next 12 months, what are the main features of the outlook for you?
I think Sage has an enviable business model. We continue to target at least 6% organic revenue growth and at least 27% operating margin. But this is also underpinned by strong free cash flow and our progressive dividend policy. So in summary, I think we have the right strategy and we've created the right momentum to fulfill our FY16 targets.
Steve Head, thank you very much.